Jump, jump, all my young homie. All my young homie, jump, 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 all my young homie. Jump, 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 jump.
What's up, y'all? Michael Manoskine here. Sorry for some of these delays. I have internet outage. It's pretty, thankfully it didn't happen yesterday. We did the Super Investor Cheat Code webinar yesterday. We had over 100 people show up. I appreciate you all. I think, a ton more signed up. They're going to get access to the recording. If you still want access to the recording and the bonuses that I gave away, including the property acquisition roadmap, as well as the Super Investor Operating System outline, you got to sign up for the webinar, even though it already happened. I think we can still send it to you. So I'm going to drop the link in here. So thankfully, we were able to get that going yesterday because we didn't have those internet issues. Today, I definitely have internet issues, so that's great. We pay too much money to not have great internet. Regardless, what I'm going to do right now is you guys have questions. Let's do some Q&A. Otherwise, I have a ton of questions that have been asked. They've really fallen to three core areas. We got one, which is co-living. We've got the other, which is capital raising. And the third is operations and systems. I've got all these questions laid out. I'm happy to just start cranking them out as much as I can. For those of you that are, newer in your investing journey or just want some free, dedicated education, tools, and resources that will help you build wealth through real estate, well, luckily for you, I have my free Wealth Through Real Estate School community. Inside, I just dropped the link there. Let's do. I do not know how to use it on my phone. All right. So for those of you who are, co-living is what you want to do or you want to learn more about it, I've got some free value and education in there as well as on my YouTube, but I also have the lowest cost, highest value co-living community that exists. It's our A to Z co-living community. It is the exact step-by-step breakdown on everything that you've ever wanted to ask about co-living provided to you, plus all the tools and resources we use within my business. My team and I created and use within our business, as well as multiple live weekly support calls to help you when you get stuck with deal analysis, when you get stuck with any project management. So how should I renovate this property? How many rooms do you think I can add? How should I furnish it? Or any operational type questions, right? So setting up your management listings, let's say on PadSplit or self-managing, you got tenant questions, things like that. You have access to deal analysis support. You've got access to project management, so renovations and furnishing. Is this a good property? As well as operational support. So you guys get direct access to that. That is in my A to Z co-living community, which is housed inside of Wealth Through Real Estate. So for only $197 a month, you can join the A to Z co-living community, get the step-by-step education and guidance, tools, resources, community, as well as those live support calls to help you fast track in your co-living investing journey. To put into perspective, most people are charging $5,000, $10,000+ up front for something that's lower quality than that. I want to help you guys succeed in your co-living journey. All right. With that being said, let's start answering some of these questions. We're going to start with co-living first and foremost. So let me drop the Wealth Through Real Estate link if you want to join the free community, get access to free courses and tools, as well as if you want to upgrade into the A to Z co-living community. All the info is in there for you. Once again, you don't have to do any of this, right? If you think it's the right fit, it's going to help you in your investing journey, great. I want to be that resource for you. If not, totally understand. Take advantage of all the free stuff and best of luck on your investing journey. That's why I put so much free stuff out there. Let's get into it. Tons of Q&A. So first and foremost was, how do I find co-living deals? Great question. So how do I find co-living deals? Well, for me, it starts fundamentally with, what am I looking for? What makes a co-living deal? So for me, it starts with my buy box, which is what types of properties am I looking for? And then to create my buy box, it starts with my investment strategy. This is something that we talked about yesterday during the Super Investor Cheat Code webinar. I have three core components of my investment strategy that has allowed me to scale from $2 million portfolio, so a couple properties, a couple small multifamily properties, and then grow and scale to over $25 million in less than 3 years of investing. It all started with this investment strategy that I went all in on, which is based on my Super Investor Cheat Code, which is comprised of an investment strategy that incorporates maximum returns, that incorporates Scalability has to be a key component, and accessibility. I want to be able to find deals and operate them effectively and not have a lot of extra time and effort to be able to grow and scale that portfolio and then make sure that everything that I'm doing has maximized results. So my investment strategy, right? And we talked about this during a previous training, which was my investment strategy focuses on 3 C's. That's the Super Investor cheat code. Co-living properties. I'm looking for co-living properties. I'm looking to buy them creatively financed. So buy them with less money down and lower interest rates. So I'm getting much higher cash flow, much higher cash on cash return. And I'm looking to buy all my deals raising capital. So all my deals have to fit inside of a criteria that is in alignment with my investment strategy. When it comes to, so that clearly says I'm looking for creatively financed deals that I can operate for co-living. So what types of properties make sense for co-living? Well, I'm looking for properties that are no less than 3-bedroom, 2-bath, ideally close to 2,000 square feet or more. So then I can convert that into a property that's going to be 6, 7, 8, 9, even 10 bedrooms by the time it's all said and done. That's the minimum standard. Ideally, I'm looking for properties that are 4-bedroom, 3-bath, 2,000 or more square feet. So then I know I have a very high likelihood of converting those into high cash flow producing co-living deals. I'm also looking to buy all of those deals creatively financed. Does that mean I don't do traditional financing, get new loans? Yeah, sometimes I do it. But there's a clear reason as to why I've been able to scale. The majority of the deals that I buy are creatively financed. Like I said, lower interest rates means more cash flow and more debt pay down. Lower down payments means higher cash on cash return, more money that is available for future investments. It also means way less bank friction and waste. I don't have to go play on the bank's timeline and go through their entire process to be able to buy the deals that I want and waste a bunch of money on additional appraisals, loan origination costs, and then once again, right, paying that extra interest, down payment, like all that stuff. I don't have to deal with any of that. That's why creative is such a huge component of my investment strategy. It means I get better results with less work overall, right? And it means that I get to grow and scale my portfolio and generate more cash flow from each and every deal that I'm buying, which is huge for me. So how do I find co-living deals? Well, I'm very clear on my investment strategy and the buy box that resonates with my investment strategy. I share that with other investors, primarily wholesalers and bird dogs, but I also have JV partnerships, right? I partner with people on deals who don't know how to structure them, a variety of ways. But I'm not at this point going direct to sellers and agents. It's not the highest leverage use of my time right now. So I'm partnering with others who might have motivated sellers. Maybe they didn't structure the deal well. What I'm doing is I'm getting those deals that they have typically under contract or close under contract. I'm analyzing the heck out of them, and I'm doing something called super deal analysis, which means I can take a bad deal and make it good, or I can take a good deal and make it great, right? Like that is what it's about. You can't just get deals from wholesalers or bird dogs and assume it's either you buy it at face value or not. If there's an opportunity to improve the deal, that's your one and only chance to do so. It is imperative that you do everything in your power to improve that deal. So that is what I am doing. I'm taking those deals and then improving those deals through super deal analysis. So how do I find deals, right? Clear investment strategy, clear buy box for what I'm looking for. I share that. Deal flow comes in, and then I conduct super deal analysis to improve those deals, put them under contract, raise the money for those deals, and then I own and then operate them within my business. So that's the full thing of finding co-living deals, right? That's how I do it. If you're in the A to Z co-living community, I also show you how to find deals on market, because that is a viable strategy depending on where you're at. And if you don't have the skills necessary for creative financing, or you don't have the relationships to get that deal flow, I show you how you can find those deals, those opportunities on market, be able to acquire them. All right, next question. Oh, look at that, resonates with the other one. Do you only buy creative deals or also traditional acquisitions? I do buy creatively financed deals, like primarily. That's 99% of the deals that I buy. However, I'm not a complete no-go with traditional financing. It just isn't the highest leverage way to buy deals. For example, like I said, if I'm buying creatively, instead of putting a 25% down payment, typically we're putting between 3 to 10% down payment to acquire that deal. Instead of paying 7+% interest rate to like the bank financing terms, I'm able to buy most of my deals between 0 to 3% interest rates. Well, that means I get way more return for every single one of my deals, instead of putting, 2.5, 3 times the amount of capital that other people do. What I'm doing instead is putting these deals under contract for much less money down, right? So that means I got my capital, my cash on cash return is higher, and I'm buying my properties with much lower interest rates, meaning I get to buy properties that generate me more cash flow because I'm wasting less money on interest. That is why I'm buying most of my deals creatively financed over traditional. There is a time and place for traditional financing. There is a great investment opportunity on market and the seller needs all their cash. Well, traditional financing solves that problem. If they only need some of their upfront cash, maybe I combine traditional financing, a new loan, with seller financing so that I put less money into the deal. We have very favorable seller finance terms, and the seller gets that initial capital they're looking for, whether it's to pay off their loan or because they want to go buy their next property or invest in something, whatever that looks like. So that is a seller carryback, right? That's a seller carryback with a traditional loan, aka the Morby method. So there is a time and place to buy deals traditionally. If the deal makes a lot of sense with a new loan and I can buy it and it solves the seller's problem and it works great for us, great, I'm going to buy it. If I can combine it with creative financing so I lower my entry costs and improve my terms, great, I'm going to go that route as well. But for the most part, I'm buying almost all of my deals subject to their existing loan, fully seller financed, or hybrid, a combination of seller financing and subject to, which means I'm getting lower entry costs, so like lower down payments, lower interest rates, and I'm able to grow and scale much more effectively. Let's see. How do I feel about ground up co-living versus a conversion strategy? Yeah, so that's a great point. The number one thing that I do is primarily the turnkey conversion strategy. What that means is I'm typically buying properties that are already in fairly solid condition, and all I'm doing is converting the common spaces into bedrooms. So if there's an extra office, dining rooms, there's 2 living rooms, whatever, a basement, whether it's finished or unfinished, a garage conversion, I'm taking the common spaces, right? Not the kitchen, but the other common spaces, and I'm converting them into additional bedrooms and renting those out by the room. For me, that is the best route to acquire deals. A, because it's much less risk. It's much less risk and much less things can go wrong. There's less variables when you are buying a property and just converting the common areas to co-living, right? It's much less renovations, much less things that can go wrong. The project can't get that crazy out of budget. It can't take significantly longer than if I was doing a full gut renovation or especially a ground up new development. There's just a lot more risk for that. Not only is that the case, but because I'm buying existing properties, typically with debt, right, in place, whether it's sub 2 or sub finance, I get that great long-term debt in that investment and it just stays long-term, right? It's not like I have to go and get a loan to buy the land, a construction loan to create the property 18 months later, then I have to, after paying tons of fees on that loan, I have to refinance that into longer term debt. There's a lot of variables, a lot of risk when you're doing that. If you're very solid in that and that's your strategy, awesome. For the vast majority of people, you should not be doing that because there's way more risk. There's honestly way worse returns because you cannot buy something like that creatively. You might be able to buy the land creatively, but that's one small cost relative to everything else in there. And a big thing for me is speed to cash flow. The strategy that I do, right, buying something and then converting it, low cost conversions to co-living, that means within 1, 2, 3 months, typically in that 1 to 2 month period, we're able to fully renovate, fully furnish, and get the property listed, generating me cash flow within months. As opposed to if I'm doing a full ground up development, it's going to take 12, 18 plus months before I generate any cash flow and I spent all that time, energy, and had all that extra risk to build something ground up or even do a full gut renovation. There is a time and place for stuff like that. For the most part, it's not worth it, especially if your goal is scale. Your goal is to keep great long-term debt in place to maximize your cash flow, have really high cash on cash returns, as well as if your goal is to actually get that cash flow in a very reasonable time frame. It's great to be able to generate, your $2,000 of cash flow 18 months from now, but I'd rather generate that same $2,000 of cash flow within 1, 2, or 3 months with way less risk involved. And I've got that great low interest rate debt in place, allowing me to pay down my debts faster as well as cash flow more. All right, so how important is the existing layout of a property within my buy box? That is huge. So when you're converting a co-living property, it is much easier when there is an optimal layout. What that means is there's a great flow to convert common areas into bedrooms. What does that mean, right? It's got a office, it's got a bonus room, it's got a dining room in addition to a living room. We bought a property that had a great room, which ended up becoming a simple 2 additional bedrooms. If they have garages, if they have things like that, those are much easier to convert over. So the layout is huge. What is the existing layout? Sometimes if you have a huge bedroom, you could convert that into 2 smaller rooms, but that's typically more work because you have to rewire electrical. You might have to add a new egress window, right? You need a second point of entry and exit there. So the layout is huge because you can have a property that's 2,000 square feet and it can have 8 bedrooms, and you can have one that's 2,500 square feet that can maybe not even have 8 bedrooms. It really depends on the layout, the floor plan. For example, one big one is if it's 2 stories versus 1 story, it's more efficient when it's 1 story. There's less wasted space. And I like to make sure that my bedrooms are on the exterior of the building, right? Not in the center, because that allows me to get those windows in there. So if I'm creating bedrooms in the middle, then I have to figure out what is really my second point of egress. Does it have 2 doors? Because it is very imperative that you follow all building codes for your properties. You want to ensure that your tenants that are living in your property, especially if you got multiple people in one house, but especially if you got several people in there, you want to make sure that everything is as safe as possible. If something were to occur, if there was a fire or something occurs, you want to be able to ensure that your tenants have that 2 points of egress. So that just means like you have 2 points of entry exit, right? Typically a door and a window that meets egress standards. You want to make sure you have that in place for your property. So the right layout allows you to do that, not adding, random rooms in the middle of a house. You want that on the exterior, and the more partially complete a room is, the better. For example, we just did the one we're doing in Dallas, going to be 10 bedrooms. One of them was, all right, add a single door, right? It had everything, just add a single door and then add a wall. Well, that wall is then combined with another wall and door to, now we've got 2 rooms with very little work done. That great room was one wall here and then another one perpendicular to it. And you have the 2 doors, and that's 2 bedrooms with really 1 long wall and 1 shorter wall. So the more easy it is to convert, the faster it gets done, the less risk your project can cost more or take longer, and it just costs you less overall, right? As opposed to trying to do something crazier, right? A much more crazy renovation. And if you have rooms in the middle, you can't get that 2 points of entry and exit. So yes, layout is huge, but I don't really, if a wholesaler or bird dog tells me I can convert a property to something, I'm still the one to validate that to make sure that it's actually possible. The layout is just as important as the existing number of bedrooms, bathrooms, and the square footage, because that can make or break the number of rooms that you can comfortably add and the cost to convert those rooms. It's not just about it's how much is it going to cost and is it worth it? Okay, let's see. What's my typical renovation budget that goes into a co-living deal? Great. So it really depends. Like I said, the types of conversions that we're doing, the lowest cost conversion is obviously something that is an office that either needs a door added to it or it needs a closet added to it, whether it's permanent or a movable structure or armoire or something, right? It doesn't have to be a permanent closet, but those are the lowest cost conversions. Add a door if you need to, add a closet if you need to. Great, you have a room, right? The next lowest cost is adding 1 or 2 non-load bearing walls and a door to convert something into a bedroom. The thing that I mentioned was in the middle, which is that, we had one huge room, that great room. So you have that 1 wall and a perpendicular wall. That's even lower cost than creating 2 of those other rooms, right? So it's those simple conversions that only need doors and closets. That's the lowest cost. Those are my favorite. That can cost between $1,000 to $3,000, if not less, if it's batched into multiple other, a bigger project. If that's the only thing you have them do, that 1 room, well, the cost per conversion is going to be a little bit higher. But if it's part of a bigger project, that cost for that conversion won't be as high because it's part of the overall renovations that you're doing. Then so yeah, between 1 to 3,000, those non-load bearing wall ones, typically between 4 to 6,000, depending on like once again how many you're doing. You also have then a garage conversion, or the next lowest cost one is like splitting a single room, like a very large room, like an existing bedroom, into 2 rooms, because now you have to rewire electrical. You might have to do HVAC or add a mini split. That's the next cost, between 8 to 12,000 roughly. But now you're turning 1 room into 2 rooms. It could be cheaper than that, right? It's really just one wall. It's just the electrical and the HVAC might cost you more money than you expected. Let me see. All right, what else do we have? And then obviously there's like garage conversions and things like that. That's like the highest cost conversion, is the garage conversion. So it depends. On average, I'm buying my deals in total with the acquisition costs, the renovation costs, like the cost to acquire the property itself, the cost to renovate it. So renovate and add the additional rooms to furnish the property, and then any reserves and carrying costs I have set aside for that property, between $80,000 to $130,000 per property. And that's with creative financing. That's with much lower down payments. If you were to go buy a $400,000 property with a new loan, that 25% down payment is already $100,000. So you have the $100,000 to just for the one part of the acquisition cost. You have the rest of the closing and acquisition costs. So let's say another 20, 30, it's already 130. You're doing another $50,000 of renovations and reserves. Now you're pushing $200,000+. The renovations typically cost, like I said, it depends on the type of conversion. It can be, we've done some as low as $20,000 depending on the number of rooms. That's a big factor here. That's why I mentioned the price per room and the type of conversion, so you can kind of do the math for yourself. If you use my free Super Investor Calculator or the paid version of it, which you get in the A to Z Co-Living community and you get in as a super investor, you can, let me drop the calculator here for you guys. Here's the free version. It'll already have some of those estimates for you. And what we say as a rule of thumb, when you don't fully know, you're just going to just estimate $6,000 per room conversion, as long as you're doing multiple of those rooms at one time. So between $20,000 to $60,000 is what it's cost me, depending on the number of rooms and the conversion style. One thing I will tell you, something I was just talking to a super investor about, is that the cash on cash return of a room conversion is usually extremely high and it drags up your overall deal returns. Let me explain. Typically, half your costs are going to go towards acquisition. You're going to need to, whether it's a down payment or cash to seller, if you're paying an agent, if there's a wholesaler involved, there's closing costs, all those things, that's your acquisition costs. There's more to it, but those are your acquisition costs, the cost to buy the property, right? That is the cost to buy the property. And if you were to rent it out as a long-term rental, it may or may not be a good deal. What makes it a great deal is now taking that same house and renting it out by the room. And then each additional room that you add might cost you $5,000 to $10,000, right? But the additional cash flow that you generate, the cash on cash return of how much you invest, that $10,000 to build a room, that additional, $500 to $1,000 of cash flow, depending on the location and your expenses, that's massively going to drag your overall returns up in the upward direction. So you're basically fighting the downward pressure of the acquisition cost to buy the property with the upward pressure of converting rooms into more bedrooms that are cash flowing you more money, and that really high cash on cash return. I'm talking about 30, 50+% cash on cash return for each room that you add on is bringing your returns massively higher. That's how I'm able to buy deals that are 15, 20+% cash on cash return, because these additional rooms increase the overall deal returns, because there's just such a high return on investment for every room that you're adding, as long as it's not impacting the quality of life for your tenants. So to give you a basic rule of thumb, I typically am all in between $80,000 to $130,000 on most of my properties. Acquisition costs are roughly $50,000 on those properties, and the rest goes towards renovations and any reserves and carrying costs for that property. How long is capital tied up during renovation before rent starts? Great question. So it really depends on the amount of renovation that you're doing. And then it's not just the renovations, it's the renovations, it's the renovations, it's the furnishings, it's all those things collectively that it takes. You get your listing and then tenants start moving in, right? That whole process takes time. Depending on the level of renovations, I budget for no less than 3 months for that project to be completed. Well, the reality of it is our operations are so tight that we tend to start our renovations literally the day that we close on the property. That does not mean we're sending contractors out the day that we close. That means we have already done all that pre-closing. We've already got multiple quotes. We've already selected our contractor. We've already verified the itemized budget. We've already given them a roadmap of what they're going to start, what they're going to do. Materials are ordered, everything, so that the day that we close, right? You don't want to prematurely buy materials and all that. But the day that we close, we're buying the materials. Materials are being sent to the property, and our contractor's already starting any renovations that they need to the day that we close. That is how you are being the best steward of your capital, so that you can get the renovations done as quickly and effectively as possible, get the furnishings done as quickly as effectively as possible, get the your listing set up and get your property full, so then you can generate your cash flow as quickly and efficiently as possible. The name of the game is how quickly can you generate your cash flow. The longer that it takes you to generate your cash flow, the more money that you are wasting in regards to, more carrying costs, but also opportunity costs. If it takes an extra 3 months to generate cash flow, when I was generating cash flow 3 months prior, I've already made several thousand more dollars than you would have. And you've taken a lot longer. You've paid the mortgage longer. You've paid utilities longer. If you're financing this stuff, if you're doing that, there's costs associated with that. The name of the game to be operationally successful is to speed up your path to cash flow. Not only with the strategy that you're selecting, why I go the turnkey to co-living, the turnkey property to co-living conversion, like buying a property and simply converting to co-living instead of the full ground up process. That's one part of it, but it's also how quickly are we getting, how much of the prep work are we doing with contractors to get them ready to go the day that we're able to renovate and get us cash flowing as quickly as possible. That is the best thing that you can do for your overall investing. Okay, so we got some operational questions. Do I allow animals in co-living properties? We do not. No roommate, like you can't split your room, no animals, nothing like that. We do not allow that. The very rare occasion in which that we will allow there's obviously protected classes that will need a service animal. That's something you don't want to be non-compliant with fair housing laws. But if it's just a pet, no pets allowed in these properties. And if it's a boyfriend, girlfriend, unless we are self-managing the entire thing, right? It's separate from the Password platform, and it's a huge room with its own entry and entranceway and its own private bathroom. We're not allowing couples in rooms. It just leads to more issues than is necessary. And if they want that, those two should just be getting a regular 2, 3, 4 bedroom and just doing the co-living strategy essentially for themselves, like my wife and I did when we were college students, as well as when we started house hacking small multifamily properties. How do we handle cleanliness, shared spaces, and tenant conflicts? So, great question. Just the same way that we do renovations and we start that process even before we actually close on the property so that we can hit the ground running day one. Same with this operational question. Cleanliness, shared spaces, tenant conflicts, all of that starts. Operations and property management does not start when your property is ready to rent out. Operations and property management start during acquisition. We are buying properties in the right markets. We're buying properties with the right layout so that we can add the correct number of rooms to that property and still maintain a high quality of life for our tenants. When we're doing the renovations, are we doing everything in our power to insulate the walls, to minimize noise issues? Do we have, are we setting up the furnishings appropriately? Right? All that plays into your property management. That allows you to fill your rooms with better tenants that pay a premium rent and then keep them longer. All of that property management does not start when the property is ready to go. Property management and operations starts when you're identifying the deal that you want to buy, when you're renovating it, when you're furnishing it, and then in addition to the way that you're operating and the house rules that you have for your property. Every single one of our tenants has additional house rules that they have to agree to in regards to cleanliness standards, how we handle tenant conflicts, all those things. It's already done. And then it's once the tenants are actually there or applying, then you're screening them effectively, right? You're screening them to see if they're a good fit for the property and, do they qualify financially? Are they a good fit for kind of who else is in that house? On top of that, then it's handling the actual tenant conflicts as they occur, but they're very minimal if you do a lot of this upfront work with when you're buying the property, how you're renovating it, how you're furnishing it, how you're screening your tenants, right? All of that leads into minimizing tenant conflicts afterwards. Tenant conflicts, cleanliness issues, all that kind of stuff afterwards. It starts with every part of the process. That's why operations are so important. And when I talk about the only 3 things you need to generate cash flow in a rental property is you need the deal, you need the money to fund that deal, and then it's the operations that actually generates you cash flow. The deal and the money allows you to buy a property. The operations is what allows you to get that deal, get it converted, get it cash flow producing. The operations is fundamentally the most important part, but like a triangle, all 3 components are vital, right? Operations are insignificant if you don't have great deals. A great deal doesn't mean anything if you don't have the money to fund those deals, right? It's all tied in together. When you maximize each of those three areas, deals, money, and operations, that is when you are getting like maximum results and scalability. That is a big thing what we talked about during our webinar yesterday, the Super Investor Operating System webinar. This was a big part of it, right? It's not just the investment strategy. It's not just these three pillars. It's not just the property acquisition roadmap that I gave away to people. They've really never seen it laid out so systematically, like the whole process. It's also the three systems that we have that tie into deals, the property acquisition system, so how you continue getting great deals, the capital raising system, so you can fund an endless supply of great investments, and the property operations system, which is everything that we talked about, getting it to closing and then post closing. So you're actually generating the cash flow and maximizing your results and taking care of your partners in those deals as well. Cool. Are tenants responsible for cleaning common areas and bathrooms? That depends. So for private bathrooms, tenants are responsible for that. For our common areas, we tend to send out a cleaner for common areas and shared bathrooms, not all the time, but on a routine schedule. And anytime we have tenant turnover, we'll also have them clean up the general areas as well. However, it is still ultimately the tenant's responsibility to maintain cleanliness in common areas and bathrooms, more importantly, to maintain cleanliness after themselves. We're not asking them to clean up after other people. We're asking them to clean up after themselves, maintain a high level of cleanliness and high standards for themselves and how they treat the property. Otherwise, they're going to be in violation of our agreements. But we also understand that stuff happens. Dust occurs and all these things. There's buildup over time. If we just allow tenants to just clean up after themselves, that's not the best that we could do to maintain a high quality of housing for our tenants. That is then sending additional cleaning for the common areas. That is also cleaning up those common areas when we have tenant turnover. Since the cleaner's already there, it's not that much more to get them to also clean up the common areas. What does furnishing typically include? That's really going to depend on the type of landlord that you want to be. We try to maintain a very high quality, very high standard for the properties that we're buying, how we're renovating them, and especially how we're furnishing them. I cannot prove to you on a spreadsheet that it is better to invest more into the right renovations and the right furnishings. I can't prove to you that that's actually financially more beneficial for you because it's going to cost you more upfront. But I'm telling you quite literally, the name of the game to maximize your cash flow in the operational phase is to fill up your rooms as quickly as possible with the best tenants, paying premium rents, and they stay there as long as possible. Vacancy, getting people in, and turnover, converting rooms back, and then the vacancy that comes with that is the most costly part of the entire operational process, right? Once you're done and your property set up, it's the name of the game is to fill your rooms with great tenants that are paying at premium rents, and then to ensure that they are staying there as long as possible, because that gets you less operational headache and more returns overall, as opposed to gaps and having vacancy. So because of that mindset, even though I understand on a spreadsheet, it looks better to save that $10,000 that you would put into extra renovations and furnishings, I'd rather put that initial investment up front to minimize my operations and to generate more returns over the long term of holding this asset, even though the spreadsheet may not show that up front, right? You'd have to adjust vacancy, but that's not really how spreadsheets are handled when you're analyzing a deal. So with that being said, that means we're trying to have bedrooms that are no less than 100 square feet, if not bigger. We try to fit a queen bed in there, ideally with a really solid mattress. We try to have a desk in there with a chair because that allows people a little bit more space and more stuff to do in their room, which keeps them there longer and happier, especially for those that work remotely, whether it's full-time or part of the time. Those are kind of the main core three minimum standards that we try to keep within our properties. Tenants like a place that has a large enough bed, that is comfortable, that they have a space in their room, and then everything else is additional benefits. For example, we like to have full length mirrors in our rooms. Why? Because otherwise, if they don't have a full length mirror in their room, they're more likely going to have to get ready in the bathroom if there's someone who wants to check their outfit and all that. I don't really understand that, since I wear like the same 5 clothes and the same 5 style of clothes and the similar hat all the time. I don't really care. I already know that it looks decent. But some people really care about that, and we respect that. And we'd rather have them spend the extra time and energy and the ability to be able to get ready in their room, not hogging up a bathroom when multiple people are sharing that bathroom. These are all those kinds of things that differentiates you from other investors, other co-living investors, other investors in general, that then allows you to make significantly higher cash flow with way less operational headache. This is a big part of it. So we have a minimum, and then we try to add additional things in there to make it better. One of those other things is a welcome kit, which essentially includes some of the key things that they'll need. For example, toilet paper, paper towels, plates, utensils, just things that makes it easier for them to move in and just to hit the ground running without thinking, oh gosh, I got to go to the store immediately. There are little things that cost, $15, $20 per person when they move in, but it sets everything off on the right foot. Your tenants have a higher likelihood of knowing that you care about your property because the condition that you maintain it in, and and what you're providing them, you're going above and beyond on these little things that do make a meaningful difference for them, which means they will more than likely, right? Can't guarantee anything, but they will more than likely take care of your property, take care of the other tenants at a much higher level. And that's what we want. We just want them to enjoy their place, take care of it, pay their rent on time, and just enjoy their discounted rent, that as opposed to paying for a 1 bedroom or whatever on their own, discounted rent, so they can go and enjoy their life, enjoy their housing, all that good stuff. It also depends on how you operate the property to help set that off on the right foot. It's a big part of how we do it. All right, we have a bunch of questions for capital raising next. If you guys have any additional questions, please feel free to drop them. I'm happy to answer any additional questions that come up. It is hard to see on my phone. I've never had to do a live stream on my phone like this. So yeah, we'll keep on going. All right. Capital raising. What percentage returns do you typically offer investors? And then another one that's similar is, what kind of interest do you typically provide investors? Those are kind of similar, right? It's basically, what interest do I pay private money lenders, and what co-ownership split do I give to private money partners, those that we co-own assets together? Great question, right? And I'm going to tell you, it's hard to answer that. I can tell you for me specifically, but that does not mean that it's going to work for you necessarily, because what you're able to offer in investors to still get the deal done and get the deal done, to raise the money and then to be able to move forward with it, is really dependent on two fundamental things. A, the deal returns. The deal has to make financial sense before you can even raise money on that deal, right? If you're offering returns that are higher than what you're generating, then that makes no sense. You're just offering returns that are not actually going to be able to be possible for you to pay out. Or if you're offering returns that are eating up the vast majority, if you're offering an investor, a capital partner, returns that are eating up the majority of your personal returns, well, the issue there is that you're doing all this work, you're finding the deal, you're operating it, they're funding it to do what? To make $100 a month once it's all said and done? That's too much work for very little return. So fundamentally, your whole thing is to find great investments. Once you have a great investment where it makes sense to pay a certain interest rate or give up a certain percentage of ownership split, that's fundamental. Like, that's the most important thing. Next is your ability and the quantity of capital partners that you have to fund the deals, right? It's the quantity and quality of the capital partners that you have to fund deals. If you have one person, you have one potential capital partner who's going to fund the $100,000, and they're telling you, I will only do it for a 20% interest rate return, or I'll only do it for 80 or 90% ownership split. Well, if you want to get the deal done and that's your only capital partner, you have to give into their terms to get that deal done, right? Like, that's the reality of it. Well, if you have several capital partners and they're willing to take lower returns because they trust you more, they're more in alignment, they feel more confident with you, the deal, and you as an operator, you can typically offer lower returns because you're a lower risk investment, right? You are a lower risk investment for them. Between the deal and yourself as an operator are lower risk, which typically lower risk means lower returns, but that means you actually get to keep your principal. That means you actually get the returns that are projected, not people who have really high returns to get deals done, but then cannot actually materialize on them. I did an entire capital raising semester where this was the fundamental component of it for the sub 2 community. So that's already in there. And then for super investors, I go even deeper into all this stuff, plus the systems that you need to raise capital and how to determine A, what returns can you offer based on the deal returns to a capital partner, and B, how to consistently build your database of prospective CALP partners. Ensure that you are getting alignment with the right people. You guys are in agreement with your investment strategy and the returns that you offer, so that when you have a deal that you're looking to fund, you have a healthy competition of potential capital partners so that you can get those deals done and you can offer reasonable returns that make sense for the partner and for yourself as well. It's got to go hand in hand. But fundamentally, what returns do you offer? And what returns do you offer is dependent on the deal returns themselves first and foremost, and then your ability to raise capital, the volume of capital partners that you have, and the basically what they deem is reasonable based on your risk, based on your experience and you as an operator overall and the deal itself. To give you guys some general rule of thumbs, people love to hear general rule of thumbs. Typically, when you have a private money lender for a buy and hold investment, it's typically at 12% interest rate return with a private money lender. Means they're lending you, let's say $100,000 for 12% interest rate return for 1 year. They lend you that $100,000. In 1 year, you have $12,000 of interest, right? 12% of $100,000 is 12% interest, which can be paid monthly at $1,000 a month, quarterly at $3,000 a quarter, or all at the very end. You pay them that interest and the principal of their loan back, the $100,000. So by the time that 1 year is done, the $100,000 loan at 12% interest, you're paying them $100,000 back, the principal of their loan, and the 12% interest on that money. Then we have private money partners, right? Those that are co-owning with you. The typical split for newer investors is typically a 50-50 split. The person that finds the deal and is operating gets 50%. The capital partner gets 50%, right? That's just the general rule of thumb. It really depends, like I said, on the deal, returns themselves, and on the volume of cap partners that you have and the risk they deem you as, essentially, that you're going to actually perform on what you're saying. So it's all that, right? Gave some general rule of thumbs to help you out. 12% PML, 50-50 split with private money partners. However, it really depends on the deal and your ability to raise capital. Let's see. Let's see. A lot of this is redundant. Okay, so what does alignment with investors mean with you? So if you know anything about my capital raising strategy, it has nothing to do with convincing or converting someone to invest with me. For me, it is all about alignment. And when I say that, I understand why that doesn't make a lot of sense to some people, because they just don't understand what that means. It's another one of those buzzwords, right? Like we talked about this yesterday during the webinar. You know that creative financing means you get better deals because you're buying them with lower down payments and lower interest rates. Great, but like, how do you do that? How do you find these deals and how do you make it as part of your overall system? You know that co-living maximizes your returns. Well, how do you find these deals? How do you convert them effectively? How do you get them rented so you're actually generating those returns? Same with capital raising. Hey, you should raise money to buy your deals. You shouldn't be using your own money if your goal is scalability. Great. Well, how do I actually do these things? That's how I feel maybe alignment is to some people, right? My whole thing is I provide the systems and the step-by-step roadmap on how to do those three core things, right? Creative finance, capital raising, and co-living, and all the systems and resources for super investors to help them out. I also give a ton of that away for free as well to help you guys out in your investing journey and have the very low cost co-living community for you to take part of and just utilize everything. Just fast track your path to financial freedom, especially through owning co-living investments, by just not trying to reinvent the wheel, but just plugging into a system that's already incredibly effective and guides you step by step and provides you the support that you need wherever you might get stuck in your investing journey. With that being said, what does alignment with capital partners mean to me? That means I'm never trying to convert someone. If someone is not already interested in investing in real estate, I'm not trying to convince someone who's not wanting to invest in anything, or someone who's dead set on stocks, wants nothing to do with real estate. So I'm only talking to people that already want to invest in real estate. Great. Then I'm ensuring alignment with, do we have the same investment strategy? Are they looking to do these buy and hold longer term investments? Are they looking to, right? So do we have the right investment strategy? Are they looking to do long-term buy and hold investments, or ideally co-living? That's another level of alignment. Is the timeline in alignment? If they're looking to get their money back in 3 months, but we're doing a multi-year hold, well, if we're not in alignment with the timeline, that's another issue. And the final component of that are, I don't want to sound cringy, but like the vibe check, right? Is this a person that I want to partner with long-term? Just as much as they're evaluating me, am I a person they want to lend money to, right? Or partner with? I'm verifying, is this a person that I also want to co-own assets with or raise money from? Because there's so much, when you have an abundant mindset, there are so many capital partners out there that are looking for great investments and great operators to partner with, that you are more of a scarce resource than money. There's a ton of money out there, but you need to find alignment, right? Once again, investment like they already want to do real estate investing. Our timelines are a fit. Our investment strategy is a fit, and we vibe check. We are similar. We don't need to be similar. Actually, a lot of my capital partners are not similar to me, but we are in alignment. Like we have similar morals and similar ethics and things like that. When we have a conversation, it's enjoyable. It's not this awkward exchange. If it's that way, great. We'll move on to the next person. No issues for that, right? The more and more cap partners that you get into your world, or prospective cap partners you get into your world, the more you get to partner with people that are at the utmost of alignment with you. You also get to turn away plenty of people like we have to, who are just not in alignment for one reason or another. Whether it's their investment strategy is not in alignment with what we're trying to do, their timeline, and most importantly, if it's not like the right vibe, right? And you kind of know what I'm talking about. It's how you make friends. It's how you do anything, right? Do you feel like you can know, like, and trust this person, and that you want to actually partner and own with them? Do you feel like this person has the mental fortitude to understand that, hey, we're renovating the property, it takes a month to do this, it takes a month to furnish, there's going to be plus or minus a few weeks as things come up, like anything? Are we in alignment? Do they seem like a right fit? Are we going to enjoy owning together? Are we going to enjoy raising money and then giving them interest? Like, does that make sense for us, or is it going to be more headache and more work than it's worth? Great, let's move on to the next person. If you don't know what I'm talking about, you just talk to enough prospective cap partners, you'll start understanding, right? I've talked to hundreds of people at this point that are prospective cap partners. And so I know, is this person going to be a right fit for me and for what we're looking to do? Or is this just not the right, this is not the right fit for us? I've had to turn people away. I've had to get people out of deals and just replace them with someone else because it just wasn't the right vibe. It wasn't the right matching, right? And that's the place you want to get to. You want to have an abundance of account partners where you can pick and choose the ones that are in alignment with your strategy or timeline, and you just are a solid fit. All right. Someone said, what if someone only wants to be a private money partner? Well, great. I have a way for you to be a private money partner on my deals. I'm going to drop my form if you want to be a private money partner. This is how you can let me know, is your timeline to invest, is the capital you have available, is our strategies in alignment? Let's get on a call, and then we figure out, is the right fit for each other. I will show you what we are doing. I will show you the types of deals that we're doing. I'll show you our strategy and what we're looking to do more of, and we'll see, hey, if I have opportunities like this, is this in alignment with what you're looking to do? And we'll just get to basically mutually interview each other and see, are we the right fit for each other? There's no surprise that when I'm doing trainings, live, off, talking to people, people share, hey, I actually love that you are so focused on finding great deals and you're so focused on the operations. I have money, but I don't have either the time or skills, or I'm earlier into my journey. I just want to partner with you, whether it's to learn through you, whether it's to get the returns with you, whatever it is, or a combination of those things. Hey, I just want to be a partner. I don't want to do all that work. I have the funds. I make good income. I just want to partner with you on these investments and let you operate them. And either I can choose to learn throughout that process or not. The more you put yourself out there, really the core thing is visibility. Are you putting yourself out there? Do people know who you are and what you're doing? Are you providing people value, right? Especially people who have capital, who want to do deals, who want to put their money to work. And then are you identifying alignment with them, right? And that is that form right there, right? I'm visible. I'm doing this right now. I'm providing value all the time as much as I possibly can, providing you guys free tools, education, resources, Q&A, answering literally, I don't know what this is, 20 plus questions live on a variety of topics. Value. And then people say, hey, can I be your partner on deals? I have money. I don't have the skills or the time to be able to do this. Great. Fill out the form. Let's see if there's alignment with our strategies. And then most importantly, let's get on a call and see if there's alignment with what we're trying to do collectively, and if we're the great fit for each other so we can grow and scale. Perfect question. I mean, it teed up everything I just talked about right before and allowed me to go more into my 1/3 of my capital raising system, the super investor capital raising system, which pre-raise is the subsystem 1. Capital raise, when you actually have prospective cap partners, you have a great deal. Now you're actually raising the capital on that deal. You're marketing it effectively with the effective presentation, with the effective analysis into your presentation, answering the most common questions already. Those that want to discuss more, you connect with them. They now fund the deal, you close on it. Now we're talking about closing and investor relations, the third part of the cap raising system. So cap raising is a system in itself, but then there's three core subsystems. The pre-raising to identify people that have alignment with you, the actual capital raising, those people that have alignment with you, presenting the deals and getting, and whoever wants to commit to that deal, and the actual closing and investor relations, everything after closing that you need to do afterwards as well. All right, operations and systems questions. Okay. How do I find and build local operations teams? So, great question. This is any service provider. Either we already operate in that system and we already have, if it's a co-living property, we already know our contractor, we already know our handyman, we already know our cleaner, we already know if we need to send a specific electrician, roofer, we already know who those people are, right? If I invest in that market, for example, Atlanta, I already know who we're going to use for all that stuff so we can get stuff done immediately. If I don't know, then I want to work with another investor who's doing the same strategy as me in the same market and get their referrals. Who do they like as a contractor? Who do they like as a cleaner? Not only is it the same market, but also the same strategy, because it's different to clean an Airbnb versus a long-term rental when a tenant moves out versus a co-living property when you're renting out the rooms. It's the same thing. So it starts with, do we have the resources in that market? No? Okay, do we know other investors that are in that market doing the same strategy? That is a big benefit of being in Super Investors, my mastermind community, or the A to Z co-living community, or even my free wealth to real estate community, because you're already in alignment with people who want to buy and hold real estate, whether they're earlier in their journey, they're actively doing co-living or trying to start or actively doing co-living, or they're at the phase where now they're just focused on scalability, raising the money, finding better great deals that are creatively financed, and then incorporating the co-living as well. Those are the people you want to connect with and ask. If you're already in other investment communities, for example, shout out to Sub2, my mentor Pace Morby in that community. There's so many investors all over the country doing the strategy that you want to do. When you focus on markets where the strategy makes sense and the investor and there's a lot of investors there, you get to tap into those resources. You get to speed up your learning curve. Instead of you making mistakes or spending days, weeks, months to find the right person, you're just leveraging all the work someone else did, and then you're providing value back to them as well, right? You're keeping their people busy, right? Which is great. But also, if you have resources that you can help them out with, great, do that as well. So we talked about your own, other investors, and obviously, if it's not like people you have relationships with or you're in communities with, you can always post, you can always Google search. That's like the third tier of it, right? Searching for local providers and looking at reviews and ratings and interviewing them and all that stuff. That's the way that we go. That's the sequence that we go in. And for anyone that's a super investor, you guys get access to my resources in those various markets, whether it's my asset manager who does project management, renovations, furnishing. She can give you all that information, operations, property management, literally everything in all the markets that we operate in. We're happy to help you guys. How do I manage properties remotely? Well, a big part of that is outsourcing a lot of the operations. You do not need to be doing every single thing. A big thing that's preventing scalability is you feel like I did several years ago that you need to be part of everything. I need to be the one that personally does the renovations, personally lists my properties, personally manages them. That is a massive detriment in your ability to scale. Sure, it saves you some money, right? Because it saves you some money because you're doing the work yourself, but that is also costing you from finding more great deals, raising more money to grow and scale your portfolio. So how do you do that? You find and interview great service providers, just like we talked about. You leverage what you already know in that market. You leverage other investors in that market doing a similar strategy, or you start researching and interviewing as well. Let's see. What systems do I use for underwriting? Well, you guys already know the Super Investor Calculator. You should know about that. It's a staple of my entire investing business. It's the calculator that I created over 5 years ago and have continued to improve and upgrade all the way up until now, and continually still upgrade as I'm doing more and I can add more to it. If I had like, hey, recreate this thing right now, I don't think I could, because it took years of doing and trying and improving and customizing and further improving to get it to the point that it's at. I don't think I have the bandwidth or the ability to just recreate that thing from the ground up. Why? It literally does everything. You can manage you can underwrite for every single acquisition strategy. You can literally analyze for properties that are traditionally financed, even cash. You can analyze every form of creative financing, whether it's sub-2, seller finance, hybrid, or Morby methods. All these are the most common strategies I use to acquire deals, in particular the creatively financed ones. I get to analyze all those on one spreadsheet. I don't need 6 different spreadsheets to do that. Next, it's very easy for me to understand. Same with the management strategies, right? I can analyze long-term, midterm, short-term, and especially co-living rentals on there. Plus, there's a co-living tab that helps me break down what is my expected renovation cost? What is my expected furnishing cost? All of my expenses are included in there. All the sections for all your reserves, as well as property management, vacancy, maintenance, and capex is already in there. So it's very seamless for me to fill it out, regardless of acquisition strategy, regardless of management strategy. And the full version, the super investor, the full version of it, not the free version, also makes capital raising extremely seamless. So once you analyze a deal and it's a great fit for you, there's literally a tab over. You click on it and it says, hey, if you had a private money partner, these are the returns if you give them this much ownership split. If you have a private money lender and you offer them this interest rate, here's the overall returns for you. Is this viable, right? This is what it's all about. It's building the stuff and making it seamless, and you guys get access to the free version. And if you join the A to Z co-living community or super investors, you get the full version. Let me drop that calculator, the free version either way for you guys, because it's literally so much value. Awesome. All right, so it's all in the, looks like YouTube comments if you guys want it. How many people are on my team? Well, my team is probably different than your team now. Just like my mentor, Pace Morby's team is much different than mine because his is much bigger than mine and mine might be bigger than yours. But as someone who owns over 70 properties, $25 million portfolio, it's still not this huge team that you would think. It's myself. And on the deal side, we have an underwriter to help do a lot of the initial deal analysis before I verify and validate everything and decide which ones we're going to buy. Then we have my asset manager / project manager, which oversees some of the operational stuff that I was talking about. She oversees, hey, let's get the insurance quote or the inspection, review it. Let's get the insurance quote. Let's get the renovation quotes. Let's estimate our furnishing budget for it. Let's get those numbers more solidified. And then once we close on it, she also handles and oversees the actual renovations, right, with the contractor and all that. That's a key part of my business as well. I'm also training her and helping her grow into an investor relations role. For all of our capital partners, since she's the one overseeing the renovations and overseeing the property management, the different property managers, she also has the most direct access to the information that our capital partners want to know. How's the renovation going? Can I get photos and videos of it? Furnishings. Can I get photos and videos of it, right? Is it done? What's the timeline? Okay, we got the listings ready. Can you share that? How is the property being managed now? Any unexpected expenses? Any income things to discuss? Any vacancy things? Since she's doing that, it makes the most logical sense instead of me being the one to provide those investor relation updates. She should be the one doing that, and that's a part of it. I've also recently hired someone who's going to be doing operations for us, as well as in-house transaction coordination, and she's going to help overall with that whole process. So basically, on the deal side, it's myself and an underwriter. For the cap raising, it's basically all me and systems and automations. You do not need a bunch of people except for the investor relations, which is then supported by my asset manager / project manager / investor relations, kind of all of the above, right? And then now the new operator who also oversees transaction coordination, the thing that you need to understand is you also need to outsource a lot of stuff. For example, we have a bookkeeper, right? We shouldn't be doing bookkeeping in-house. We have bookkeeping. We have a fractional CFO, and we have a CPA. That's our financial team. We have property managers, right? That's our property management team. Those are kind of the two core things that need to be done by someone else. Same with transaction coordination, but at the volume that we're at now, it makes sense for it to be in-house. For a lot of people, you should be outsourcing a lot of that kind of stuff. And for super investors, you guys already know you get access to my project manager / asset manager to help you out when it comes to, where are you stuck? That's why there's so many live support calls. And she does a support call inside of the A to Z co-living community as well to help you with that kind of same stuff. All right, cool. we're going to call it there. I'm going to go hang out with my family. So I appreciate you guys. Hope you had a great live office hours. Hopefully I answered a bunch of your questions. Keep dropping and sharing questions, especially in the Wealth Through Real Estate School community, my free community where you get free training, tons of free trainings, as well as the free version of the Super Investor Calculator, tons of other resources to help you out, whether it's what is real estate investing? How do I actually leverage this for financial freedom? How do I analyze deals? How do I bird dog? How do I make money finding great deals and earning while I'm learning? What is co-living, right? Also where the A to Z co-living community is housed in there as well. So take advantage of all that stuff. Tons of free resources to help you guys out. Appreciate you guys. No live office hours the next 2 weeks. I'll see you guys in 2026. Hopefully between the financial freedom roadmap series I've done the last couple weeks and the super investor webinar yesterday, plus a lot of recent posting, you have a very clear plan for how you're going to progress towards financial freedom in 2026. If you don't, drop comments. Let me know where you feel stuck and let me see if I can help you guys out, whether it's personally or supporting you through, if I create new products, new trainings, new videos, whatever, while I'm not doing the office hours the next couple weeks. So I appreciate you guys. Thank you. Have phenomenal Christmas, Hanukkah, Kwanzaa, holidays, New Year, all the above. Whatever you celebrate, I love you for it. Enjoy it. Best of luck. Hope you guys, do phenomenal in your investing journey, and make sure to enjoy some time with your family. That's what all this is about. I'm not doing financial freedom for cars and watches and any of that crap. I'm doing it because for me, it's about time with family and quality time. Make sure you're enjoying the journey just as much as you enjoy the destination. Later, y'all.
Sure, sure, all my young